Inflation is an economic wrecking ball.
Yes, that's right. Inflation is an incredible economic wrecking ball. And in this video, this market update, I am going to prove it to you with a series of alarming facts and charts. And I'm going to prove it to you the inescapable conclusion that not only are interest rates going to stay higher for longer, but if you watch this video to the end, you're going to have all the information that you need to understand what's going on in the economy, in the markets, and its direct impact to both the stock and the bond markets. Okay, so welcome to DLA Markets. This is my weekly update. And in this video, we're going to cover a lot of ground. So buckle up your seatbelts and let's dive right into it. Okay, so to start out, we are going to take a look at several things that are that we're seeing in the market today. Starting with the energy complex, and we'll take a look here. This is, oil, both WTI and Brent crude have been on a tear recently. Okay, and as you can see from this chart, they've basically WTI has gone up, close to 40% from the low just a few months ago, which is really incredible. And we've rarely seen moves like this quickly. And of course, the rise in oil prices and all the attenuant things that happen from that, because so many different products are made from petroleum products, and also obviously the impacts to transportation, gas prices, everything that affects the economy is dramatically affected by the rise in oil. Now, we've talked a lot on this channel about why this is bad government policy by the Biden administration, the Saudis cutting production, Russia cutting production, the war in Ukraine, a lot of geopolitical factors going into this. But many experts, including Goldman and many others, have expressed the view that I have too, that oil is going to hit $100 a barrel in the pretty near term, and it's going to stay there. Okay, so this is the first sort of pillar in the discussion today when we're talking about where we are with both the economy and the markets. All right. Okay, now we move over here to the next topic. Whoops, I didn't mean to do that. Next topic is just to talk about inflation and just what a killer inflation is, not only to consumers, but to the economy in general. You look at energy costs, all right? The cost of gasoline going into your car has gone up dramatically. Everybody knows that. Heating oil has been going up. Electricity has been going up. All of the basic needs for energy have been going up. But one of the most um, you know, important aspects to the consumer and to the economy is the cost of shelter. And if you look at this chart, this is a really sobering chart, and you can see the enormous peak here that's happened, you know, very recently in the last few months. Shelter has gone up the entire year for largely rent, and this is really hurting consumers. Okay, they talk about on CNBC and all of the business channels that you see, these clowns come on and talk about, oh, inflation is moderating, the Fed's going to be cutting interest rates soon. This couldn't be farther from the truth, and I hope after you see this video, you're going to understand why. Okay, so shelter is a big component of that. Next up, we have another data point that shows the duress that consumers are under. And this is total credit card balances. Okay. And if you look at the time period from 2020, this thing has gone up like a hockey stick. All right. Consumers are under stress. The rising prices of everything are going beyond what they're making uh, from their jobs. And as a result, they have to put more and more purchases on their credit cards. Okay. So when you see that consumer spending is holding steady and they use that as a reason for why the economy is strong, while it temporarily might be a reason why it is strong temporarily, it's because people are taking on more debt to maintain their lifestyle and in some cases just buy groceries. Okay, this is a very dire situation and it's completely unsustainable. Next, I always like to look at money supply, which is M2. That's money in circulation. So, for those that aren't familiar with this term, money supply is a measure that the government uses to determine how much money is circulating throughout the economy. Okay. And you can see at the end of this chart from 2020 on, the money supply has basically exploded. Okay. And this is from the Fed printing money, the Fed keeping interest rates too low for too long, and our imbecilic government spending money that it doesn't have, known as deficit spending. In other words, they're going out into the market, they're borrowing money and they're spending it. And this spending, since Biden has taken over, is close to $6 trillion. This has never been done before in the history of humanity. And people don't talk about it enough. But this spending, the infrastructure bill, the Inflation Reduction Act, which is extremely humorous, and other spending bills, that the rescue plan that was over a trillion when he first came in, trillion two, I think it was. All this money being flushed into the system temporarily blows up the economy and drives prices higher because it increases demand. Now, you can see at the end of this chart, there was a period a year or so ago when it came down, but it's leveled off and it appears to be going up again, which is sort of surprising. And I don't really understand why that is. The only way that could happen is if the Fed was printing money again. And we've been told the Fed isn't printing money anymore. What they're doing is they're actually decreasing their balance sheet through quantitative tightening. And that's called QT, quantitative tightening. They're actually reducing their balance sheet, whereas when they're increasing their balance sheet and buying securities, that's called quantitative easing, which occurred throughout this entire period, which helped blow up the money supply. Another data point here, look at total debt balances for households, consistently gone up. It's further evidence that people are taking on more and more debt just to maintain their lifestyle. And while this can prop up the economy, and it has propped up the economy for a period of time, it's clearly not sustainable. The duress that we're seeing in consumers can be seen in another data point here, the growing auto loan problem. These are the increase in growth of delinquencies on auto loans. You can see that Gen Z people and also millennials are most susceptible to this because the largest percentage of their um, income goes to car payments. And you can see how it's just rising here. 18 to 29, 30 to 39 are the biggest increases, and so on and so forth. But this is further evidence that there's pressure on the consumer, and these auto payment problems are increasing. And you can see here the delinquency rates are approaching where they were in '07 and '08, which was a time of extreme financial duress. And I just want to point out that we are approaching those levels in the current market. And if that weren't enough, and if you were to look at delinquencies on credit cards, you would see a similar pattern. If that weren't enough, personal savings rate is dropping into the toilet, like very rapidly, as you can see from this chart. Um, During the pandemic, you can see in 2020 it was very high. It came down precipitously in 2021, went up a little bit in 2021 and 22, and then completely started to crater. And so the saving rate is cratering. The consumer's running out of money. They're delinquent on their credit cards and car loans. And it's just a matter of time before the shit hits the fan, if you know what I mean. Okay. I want to keep this a family show, but let's use some of these swear words for emphasis. Okay. So all of this, if that weren't enough, all of this is compounded or compounding, I should say, the inflation picture by these endless labor disputes. Okay. UAW is in the headlines now, striking the major automakers and demanding really incredible increases to their pay. They want over 40% increase in pay, but they only want to work 32 hours. And they want full pension benefits again. They don't want this 401k garbage like everybody else gets. They want full pensions. Obviously, these demands are unrealistic. Um, the the automakers are saying it'll basically, bankrupt them. There's a little bit of class warfare thrown in here. Like, why do the executives make so much and we're getting screwed? Look, I understand why all these labor unions are demanding higher pay. We're all suffering with this horrible inflation, and prices just keep going up for everything. I totally understand why labor wants more money. We all want more money. I'm not saying their demands are not justified. It's just that there is a limit to how much can go on here. We've discussed previously the Teamsters basically put Yellow Corp, which was a major trucking industry, one of the oldest trucking industries in the country, basically put them out of business with their labor demands. That happened a few months ago. FedEx, UPS all got enormous pay increases and benefit increases. So this is going on, and I said that it's justified because everybody wants more money, everybody needs more money, but the price is going up. But the problem is that this is just another aspect of inflation. Okay, this is another way that inflation embeds itself into the economy and into the system, and it is just making a bad situation worse. Okay, let's take a look at how it's affected the markets, right? Because after the Fed came out last week and said basically, we're taking a pause, right? Taking another pause. What the market understood was it was a pause, but based on what Powell said, it was a hawkish pause where he didn't, indicate in any way, shape, or form that rates might be lower. And the sentiment of the market has been for some time, oh, since the headline CPI number is coming down, that means that the Fed's going to start easing and lowering interest rates in 2024. Okay. For a very long time, that was the sentiment. And that contributed to the rally year to date that we had up until a month or so ago. That combined with the AI hype and margin expansion. But Basically, what's happening now is the market, and what really has changed the sentiment in the last couple of weeks was that Fed meeting and his speech, where basically he said, "Hey, listen, guys, okay, we're pausing, but don't think we're going to like lower interest rates anytime soon because that ain't happening. In fact, we might raise more." Okay, and a lot of people have come out. Jamie Dimon, a lot of very respected people have come out and said, "You know what? Expect 7% interest rates." Interest rates are going to stay higher for longer. So now the market finally gets it into its head, and this is the stock and the bond market, that rates are going to stay higher for longer. So I've been saying that for about 9 months. And if you go back on the channel and you look at my past videos, you'll see when everyone was saying, "Oh, they're gonna, lower interest rates soon because the CPI is peaked and the CPI is coming down, so therefore they're going to start, you know, lowering rates." If you looked at the components underlying the CPI, like services, like shelter, like car prices, on and on, food, on and on and on, you could see that inflation in certain areas, largely in the goods sector, has been coming down, but in the services sector, it's still high as hell. And you can make the argument that in some cases it's going higher. Okay. Last print I saw on shelter on an annual basis, it's up 7.8%. Now, shelter and food are two things that you can't scrimp on. Okay. You got to eat, got to have a place to live. So these are necessities. Okay. These are not luxury items. Okay. So now the sentiment is higher for longer. Okay. So now look at the 10-year treasury. 10-year treasury is at a 16-year high, 4.72%. It's bouncing around this level. I saw earlier today it got close to 4.8%. Okay. This is a huge move. I mean, it's gone up 72 basis points since September. That is a huge move in the bond market. Okay. So there's enormous volatility in the bond market. And I've said many times, um, if you want to understand what's going on in the stock market, look at the bond market. And right now, the bond market is extremely volatile. And this is why the stock market, last time I looked, was the Dow was down almost 500 points today. Okay. The chickens are all coming home to roost here. People are finally getting the message, and the message is not good. All right. Let's take a look at some of these other things I have here. Okay. The 6-month treasury, it's almost 5.6%. Okay. That's the shorter end of the curve. The 3-month is over 5%. It's, you can basically get a riskless rate of return at the short end of the curve with no capital risk. You can make over 5% riskless. Okay. So that's what the stock market is competing with. Okay. It's no longer zero interest rates, guys. Okay. We're in a situation where you can get 5.6% for locking your money up for 6 months in a T-bill. Okay. No risk. So eventually this begins to systematically take apart the stock market because the um, earnings estimates are still far too high. People still think that rates are going to come down in 2024. And I think as time goes on, they're going to realize, more and more people are going to realize systematically that that view is wrong. Rates are going to stay higher for longer, and they might even go higher. Okay. The other thing that nobody talks about, dollar. The dollar. Look at this. Look at this move in the dollar. The dollar is rallying like crazy. Okay. I've done some content on the dollar. Um, the dollar going up is a direct result of interest rates going up, which is a direct result of inflation staying persistently high. Okay. You have to understand these relationships. When the dollar goes high, the cost of everything to the world, because most important transactions are done in dollars, the cost of everything goes up. It's incredibly inflationary. Okay. And if you are a foreign country and you borrow in dollar denominated securities and the dollar goes up relative to your currency, like in Brazil or someplace in South America or wherever you're talking about in the world, then paying back your debt is going to be proportionally more expensive. Okay. And so this strong dollar, which is directly tied to rising interest rates and the perception in the market that bond rates are going to stay high. And the reason that increases the demand for dollars is because people are converting their currencies into dollars and buying treasuries. Okay. Um, and the higher the rates are, the more attractive they are. So it's sort of like a vicious cycle. So this is bad for the world economy. And we're going to have to see how that plays out for not just the third world countries, but any country that borrows in dollars, dollar denominated securities. This is how it's so far affected the market, the stock market. Uh, the Dow, here you see it. This was yesterday, but today it's down another 3 to 500 points, right? The SPY, which is basically the S&P 500, you can see a similar sell-off. And the only one that's held up pretty well is the NASDAQ, which here I'm showing the QQQ, which exactly tracks the NASDAQ 100. You can see that this has had sort of an up and down kind of pattern. But today, when I last looked, it was down 2%, which is a big move for the NASDAQ. Another thing we like to look at to gauge the effect of all this is the VIX, which is a measure of volatility. Now, everyone was wringing their hands this morning on television. Oh, the VIX broke 20. Oh, the VIX broke 20. I've said many times on this channel, 20 is not that high. Okay. At the peak of the last crash, 0809, no, even we don't even have to go back that far. Let's go back 2020 at the peak of COVID. The VIX was 80 at the bottom of the market. The VIX was 80. Okay. 40 is considered high. 20 is considered, 15 to 20 is considered normal by historical standards. But recently we've seen very low numbers on the VIX. The VIX is going up. That indicates increasing volatility. And we're going to continue to see that. But you're not going to see the market bottom in this round of volatility until you see at least a 40 on the VIX. Okay. So keep that in mind when you're looking at this. Okay. Now, this is my favorite chart, and it's the way I want to kind of talk about, the conclusions here in terms of where we are with all this. The reason I say Jerome Powell's clown show is because, we're in this mess for two reasons. One, mismanagement by the Fed, and two, mismanagement by the government, meaning the federal government and their spending policies, right? And I like to keep Clown Powell up there just as a reminder of the foolishness and some would say, incompetence that we've seen. I believe that Powell is probably the most incompetent Fed chairman we've ever seen. And the reason is I think he's too political, and I think he's afraid to do what is necessary to really slow down the economy, uh, increase unemployment, which of course nobody likes to see, right? Nobody likes to see an increase in unemployment. But until you see a material increase in unemployment, like to the 6% level, you're not going to see the decline in consumer spending that we need to see in order to kill inflation. If this inflation continues to persist, all of those charts that I showed you are going to continue to stay bad and get worse. Okay. Truly, inflation is an economic wrecking ball. It will continue to wreck the economy. Uh, People will not be able to withstand these high prices for much longer because their earnings in real terms, meaning net of inflation, are actually going down. Okay, everybody's income is going down, and it's only going to be a matter of time before they're tapped out, and you're not going to be able to continue to spend the way you were, and people are going to start pulling in, and when that happens, the inevitable conclusion is we're going to have a recession. Okay. I just want to spend a minute on talking about this whole soft landing, no landing narrative that you hear in the stock market, and you hear by money managers that come on CNBC and Bloomberg and Fox News and all these places. Um, these people, you have to understand, have an agenda. Okay. Their agenda is for people like you to buy stocks. Okay. If they turn negative on the market and don't come up with some, fantasy about how stocks are going to be higher 6 months from now, people won't buy stocks and they won't make any money. Okay. So keep in mind when you see a money manager come on one of these programs, they're frequently um, pitching a narrative. And a lot of these guys on CNBC, for example, are completely in the tank for the government or or the money managers or whatever the case may be. I see far too many people, optimistic in the face of the Fed, excuse me, continuing to raise interest rates and tightening credit. I mean, yeah, look, I'm a positive person. I like to stay positive. I don't like to be negative all the time. And some of you might think, "Oh, Greg, you're a perma bear. You're always negative on the market." Well, I've only been negative on the market since the Fed started tightening and raising interest rates. Marty Zweig said, and if you're younger and you don't know who Marty Zweig is, look him up. He was a market guru in the 80s and 90s. He famously said, "Don't fight the Fed, don't fight the interest rate trends, and don't fight the tape." Okay. And those words were true then and they're true now. My prediction is this higher for longer is going to turn into rates going even higher from here. Something's going to break. I don't know what it is, but something big is going to break. Notice how they don't talk about the banks anymore, as if that problem went away. Problem didn't go away. Okay. They talk about commercial real estate and all the disasters in commercial real estate with the valuations, with rates going up, etc. I've done some great videos on that. I'll put those in the description below so you can take a look at. But people don't talk enough about what's going to happen in the corporate sector when the debt starts coming due in the next 24 months and interest rates are 500 basis points higher than when they put the debt on originally. That is going to be something to behold as the entire corporate sector begins to implode. Okay. That certainly is not factored into the market today. So I think you want to keep an eye on all of this data that I've given you. You want to connect the dots. You want to understand what's going on. It's very complex if you don't have a background in it. But I think to summarize, I would simply say that what I said actually a couple weeks ago, which is things are going to get rough in the market. We're going through October, November time period now. Things are going to be very volatile as people realize what's going on. And I think this is a good time to be cautious, to be defensive. I still think the short end of the Treasury curve is one of the best trades out there. And other than that, I would be in energy and on a selective basis, I would still be in the larger tech stocks. But aside from that, those are long-term holdings. Aside from that, I'd be very cautious in here and keep an eye on this channel and keep an uh, eye out for my updates. And I wanted to announce, this is a big announcement for me. I wanted to announce that uh, due to popular demand, I am going to do a market update every Friday at 5 o'clock Eastern Standard Time, and that's either going to be in the form of a broadcast like this, uh, a a traditional video, or a live stream, and or a podcast. I might invite some guests on at that time period, but I'm going to try to stick to that 5 p.m. every week, and then I'll do my regular content that I've been doing during the week, either on the markets or some interviews with some fantastic people like Elon Musk or Warren Buffett, or whoever, Stanley Druckenmiller, the people that I've brought on and featured on the channel to try to give you their perspective. Okay, so thank you for joining today. Hope you got a lot out of it. If you did, please like, and if you're not subscribed, subscribe. Come on, where you been? You got to get with the program here. Got to get with the DLA Markets program. You got to subscribe, baby. And I look forward to the next video. And until then, keep an eye out in the markets. Take care, and I'll see you on the next video.